Hello and welcome to the Weekly Forex Outlook at xm.com. Next week, dollar traders will be keeping their eyes on upcoming ISM PMI data and the US jobs report. In addition, the RBA will deliver its policy decision. Euro traders will look out for CPI data, which could impact the ECB's next moves. And yen traders will focus on the Bank of Japan's summary of opinions for clues on the bank's future path. I'm Maria Pachurdes, and joining me to unpack all this is senior market analyst Haralambos Bisigos. So Haralambos, Fed Chair Powell struck a cautious tone on Tuesday. Can you give us a brief overview of what he said and the reaction in the dollar? And also, what can we expect from the ISM PMI data for September, due out on Wednesday and Friday, and the US jobs report, also due out on Friday?
Hello, Maria. Yes, Powell sounded cautious on Tuesday, trying to moderate expectations about aggressive rate reductions from here onwards, and thereby the dollar strengthened. He said that the Fed needs to continue balancing the competing risks of high inflation and weakening job market in their coming decisions. But still, the market remained convinced that a total of 5 additional rate cuts may be warranted by the end of 2026, which contrasts the Fed's own projections of 3 rate cuts, quarter-point rate cuts by the end of 2026. So with that in mind, the ISM PMIs and Friday's NFPs may attract special attention. Now, the preliminary S&P Global PMIs for the month of September revealed some weakness in business activity, which, if confirmed by the ISM figures, could add some credence to the market view that more than one rate cuts may be required next year. However, most of the reshaping in the implied path could be driven by the non-farm payrolls. Now, the last couple of jobs reports came in well below market expectations, while there have been strong downside revisions to prior months as well. Overall, the trend in employment growth points to a significant slowdown, and another weak print could prompt traders to sell their dollars again, as it will confirm the market's dovish rate outlook. Now, the opposite may be true in case the data surprises to the upside, of course.
Moving over to Australia now, the RBA cut interest rates by 25 basis points at its last meeting in August. What data has come out since then? What can we expect from the next policy decision, which will be on Tuesday? And how is it likely to affect the Australian dollar?
Since the latest RBA meeting, the unemployment rate declined to 4.2% in July and stayed there in August. And most importantly, the monthly CPI year-on-year rate surged to 2.8% in July from 1.9% and rose even further to 3% in August. This encouraged market participants to push back expectations of the next quarter-point reduction, and they are currently fully pricing the next rate cut to be delivered in February 2026. For this meeting, there is only a 7% chance of a rate cut, with the remaining 93% pointing to no action. Now, this week on Monday, RBA Governor Bullock said that since the August meeting data have been in line or slightly stronger than expected, though the economic outlook continues to be clouded by uncertainty, and that they need to be prepared to respond. So, if the statement, the RBA statement next week echoes that slightly dovish message, investors may be tempted to bring forward the timing of when they expect the next rate cut, perhaps to December or even to November. Actually, there is a 40% chance for a rate cut in November. So, something like that could indeed prove negative for the Australian dollar.
Turning to the Eurozone now, the ECB kept interest rates unchanged at its last meeting. What's the current state of inflation in the Eurozone, and what might the upcoming CPI data mean for the ECB's next moves and the euro?
The ECB has signaled that inflation is where they want it to be. And President Lagarde, at the press conference following the latest decision, said that the bank is in a good place. So, with that in mind, investors scaled back their rate cut bets, pricing in only a 35% chance of another 25 basis points rate cut by June 2026. However, Vice President de Guindos recently said that they are closely monitoring the euro's nominal effective exchange rate rather than just the euro's levels against the US dollar. Now, that effective exchange rate is hovering at record highs, up 27% over the past decade. This means that a stronger euro will not only cause inflation to undershoot the ECB's target, but also harm trade and subsequently the euro area economy. So further cooling in next week's inflation data could increase the chances of a contingency cut by the ECB to protect the economy, something that could weigh on the common currency.
And finally, in Japan, we'll get the summary of opinions from the BoJ on Monday. What should yen traders expect?
Following the latest hawkish Bank of Japan gathering, there is a strong 55% chance of 25 basis points rate hike at the bank's upcoming decision, with a probability of that happening by the end of the year rising to around 80%. And 25 basis points hike is almost fully priced in for January. So, the summary of opinions on Monday may offer more clarity on how officials are planning to move forward. However, those awaiting a crystal clear message may be disappointed. And the reason is that the Liberal Democratic Party will hold an election on October 4th to decide for Prime Minister Ishiba's successor. That choice could prove influential for monetary policy thereafter. So, even if policymakers lean towards raising interest rates in coming months, a hike will not be set in stone. The yen failed to capitalize on the Bank of Japan's hawkishness, and even if it rebounds in the case of a hawkish summary of opinions, it is unlikely to recover all its recent losses. Some traders may remain skeptical that the bank may proceed at a slower pace in the future, should Ishiba's successor be seen as pro-monetary easing.
Harlem, thanks so much. This was the Weekly Forex Outlook here at XM.com.